Right now, a 3-kilometer stretch of water is holding the global economy hostage. Not an army, not a missile. Insurance paperwork. And by the end of this video, you'll understand why that's actually scarier than the bombs. Everyone covering this conflict is focused on missiles and military posturing. They're missing the real story. There's a single number, a threshold on commodity trading desks that determines whether this stays a price spike or becomes a global recession. We'll get to that number. But first, the mechanism that's already done more damage than any Iranian missile. Here's what nobody's explaining properly. The Strait of Hormuz. 33 kilometers wide at its broadest point. The actual shipping lane? 3 kilometers in each direction. Through that gap, every single day, flows 1/5 of the world's oil, 20 million barrels, $500 billion in annual energy trade, plus 1/5 of all global LNG. Saudi Arabia's oil, Kuwait's oil, Iraq's oil, Qatar's gas. All of it exits through this one corridor. Now, Iran has been threatening to close this strait for 40 years. They've never actually done it. So why is shipping completely dead right now? Here's the mechanism nobody's talking about. The insurers left. When Iranian drones started hitting tankers last weekend, Lloyd's of London and the major maritime war risk underwriters pulled coverage for the corridor. No insurance, no bank will finance the voyage, no captain will sail it. The ships just stop. Iran didn't need a naval blockade. They needed about 4 drone strikes, and the actuaries did the rest. Now here's the question you should be asking. If 20% of global oil supply just got cut off, why are prices only up 7%? Because the market knows something, and it might be wrong. Oil markets are priced on the margin, the last barrel of supply. Right now, the world went into this conflict oversupplied. China spent February hoarding crude. Tankers parked offshore as floating warehouses. Those barrels buy time. That's why Brent is in the high 70s and not 110. Yet. But here's the number. $90. That's the threshold where sustained oil prices start doing real damage to the global economy and to Trump's domestic messaging. The same pressure that triggered rapid tariff reversals earlier this year. If Brent crosses $90 and holds for 2 weeks, watch for a policy shift. That's not a prediction. That's the mechanism. Think about what $90 oil looks like on the ground. A fertilizer plant in India, priced out of next season's crop production. That decision is being made right now. And the variable that decides how many more follow? Duration. 1 week. Manageable. A month. Bank of America says a prolonged closure adds $40 to $80 per barrel. That's $100 oil. Minimum. And oil is actually the smaller part of the story. There's one supply chain item most people would never connect to the Strait of Hormuz, and it's probably in your medicine cabinet right now. 84% of the crude through the strait goes to Asia. China, India, Japan, South Korea. Their factories, power grids, and transport networks run on Gulf energy. When supply tightens, they outbid everyone else for alternative barrels. Prices go up for everybody, even countries nowhere near the Gulf. But oil is just the first domino. 30% of Europe's jet fuel transits this strait. 1/5 of global LNG, the gas that heats European homes, comes through here, mostly from Qatar. Qatar already shut down LNG production after drone strikes. European gas futures surged 40% in a single day. And then there's the one I mentioned. Petrochemical feedstocks, the raw materials that become hospital IV bags, insulin packaging, food-grade plastics. They ship through this corridor. 1 month of closure and your local pharmacy starts running short. That's the domino nobody's tracking. Every major container line, Maersk, MSC, CMA, CGM, has halted bookings through the region. The Red Sea disruption in 2024 took months to hit consumer prices. This is bigger. We've been here before. OPEC embargo. Oil supply cut by 5%. Just 5%. Prices quadrupled. Western economies went into recession. Petrol queues stretched around city blocks. That was 5%. This is 20%. Anyone telling you where oil goes in 30 days is guessing, including the banks. But here's what isn't a guess. The insurance exclusions that shut down Hormuz don't expire when the bombs stop. They expire when the actuaries decide the risk has changed. And actuaries move slower than generals. The strait could go quiet tomorrow. The economic damage won't. The Strait of Hormuz closed because a spreadsheet said the math didn't work. That same math is now being applied to the Taiwan Strait, the Black Sea, the Red Sea. Every choke point where global trade meets geopolitical risk. We are building the case file now. Subscribe and stay close.